Okay, terminus for growth. So first is profit margin. The second is dividend policy. Take a step back. Profit margin, measure of operating efficiency. Dividend policy. So the decision whether we're going to pay it out, or reinvest it in the firm. So, sometimes the dividends are paid, even when they shouldn't necessarily be paid. Basically, as a just to keep shareholders happy, but that that decision could actually decrease the value of the firm or reduce the growth rate and so forth. At the financial leverage, choosing an optimal debt ratio, and then total asset turnover. Note that these three are basically the DuPont identity. So the next caveats regarding financial planning models. The financial planning models don't necessarily indicate which policies are the best. The models are simplifications. We use, the world can change. We've obviously seen that recently, but what worked, 1 year, for 10 years or 20 years may not necessarily work. We've certainly seen that over the past 40 to 50 years with the enormous changes in technology in our world. Without some sort of plan, the firm would potentially find itself adrift, without any guidance. So they are useful. That we just have to qualify. We have to understand that they are models and estimations, and they are only as good as the assumptions behind them. So, it's the end of the chapter. So, quick quiz. So first, how do you standardize balance sheets? So what you do is you divide all the entries by for a balance sheet. You divide all the entries by assets, and that gives you the percentage that line item's percentage of the assets. The income statements we do as a percentage of sales. Why is standardization useful? Well, for one, it allows us comparison. It makes it easier to compare year-over-year financials, and it also allows us to compare companies of different sizes as opposed to comparing different numbers, maybe sales or so forth, for a company. The major categories of financial ratios: first is liquidity, second is leverage, next is asset management, then profitability, and then market value ratios. So you can go to the chapter for the computation of the ratios in each category. The problems associated with financial statement analysis. Okay, so problems associated with financial statement analysis. The benchmarking can be difficult. You may not have especially if we're dealing with a multinational, it can be hard to compare those firms, especially with globalization and so forth. Accounting procedures, both the elections made by U.S.-based corporations or different accounting requirements in foreign countries versus U.S. So forth, and so I think that's pretty much it. So purpose of financial planning, we're simply trying to forecast the impact of our decisions and try to as closely as we can, estimate what the results are going to be. We know that they're never going to be perfect, but hopefully they're going to be useful in helping us make decisions. The major decision areas involved in developing a financial plan: so sales forecasts, pro forma financial statements, asset requirements, so how much, what type of financing, how are we going to acquire that, financial requirements, uh, uh, economic assumptions, what's the economy going to look like. So the percentage of sales approach is we're going to assume that the costs appear costs vary along the lines of sales. Some will, some won't. We need to determine which ones will and which ones won't. And that'll allow us the forecast to be more accurate. So then next, internal growth rate. So internal growth rate is the rate at which a company can grow without just using retained earnings, without any external financing. And then the sustainable growth rate is how a company can grow using external financing and maintaining the debt ratio. And then finally, determinants of growth: the profit margin, dividend policy, leverage, and total asset turnover. The three of the four are part of the DuPont identity, so it should be noted. So that is the end of chapter 3.